We have a great question here from Marlo asking about the VIX. Obviously, we've been spending a lot of time on the VIX index lately and talking about some of the key levels that we've been trading around. And Marlo wants to know whether a VIX above or below 30 is deemed as a significant level. Essentially, in a nutshell, asking, what is a normal VIX? So this is a really fantastic question, Marlo, and this video should help you navigate this very important index a lot better in terms of the actual levels that really matter. So I didn't want to just give you random numbers. I extracted the actual open, high, low, and closing prices a while ago for the VIX, dating back all the way to 1992, as you can see on the screen here on this Excel chart. Now, there is something to keep in mind about this data. This is obviously from CBOE, the creators of the VIX, and they made a methodology change, the way they calculate the VIX in 2003. So that means that all the VIX data pre-2003 is actually called VXO and not VIX, while all the data after 2003 is what we now call the VIX. It's essentially the same thing, just a slight change in terms of the methodology. And I actually made all of the calculations with and without the VXO data, so basically in terms of different time periods. And you'll see from the numbers that the difference is actually very negligible in the bigger scheme of things. Now, for interest's sake, the first thing I wanted to show you is a graph, really the historical closing prices of the VIX going back all the way to 1992. And alongside, I also measured the daily range or the variance by simply subtracting the high of that day and the low of that day. And you can see that alongside the closing prices, which is the blue line, you can see the variance actually in the red. Now, in it, what's interesting for me is to see that the size of those one-day moves. So whether it's a move from the low to the high to the low, there's been some pretty significant variances in terms of the speed that the VIX can travel with. And obviously that, you only need to be in the markets for a short period of time to know what type of impact something like a VIX spike or a VIX drop can have. So it was very interesting to actually see that displayed on a chart like this as well. Now, apart from that, trying to attempt to answer a question like yours, like what is a normal VIX, there's a couple of challenges that we run into because there are various ways that you can measure the normal, so to speak, of something. Apart from the usual things we use, like the average of a data set, it's also best to look at things like these through the lens of not only the mean or the average, but also the mean, the mode, and the median of a data set to get a better understanding of what that normal really is. Now, keep in mind, like we said, that I've split the data into three different sections. A total range stretching from 1992 to current. Then the second set is from 2003 to 2021. Remember that the methodology changed, obviously. So I wanted to include that as a separate period without the VXO data. I did in this case the methodology, that even though that methodology has changed, we can see that it really didn't have a major impact in the data, but I wanted to have it as a separate one just to be absolutely clear in terms of the numbers. And then we have a third set ranging stretching just from the financial crisis to now. The reason for differentiating that third set with the global financial crisis is just to give us a little bit of peace of mind with the data, comparing apples to apples, because the size of the spikes in volatility, going back to that chart, obviously we've had some huge spikes in terms of historical volatility from 2008 or 2007 onwards. So I wanted to see what type of difference, whether there was a big difference between starting at 92 and ending at 21, between something like 2007 and 2021, to see whether there's like a big spike between that data. But you'll see it's actually very negligible still. So starting with the various measures then, we'll start with the most common one, which is of course the mean, or what we usually call the average, which is where you add up all of the numbers in the data set. So in this case, it'll be all of the VIX closes. We add up all of the numbers and then divide it by the number of numbers. Now, the challenge of averages is that there are clear outliers in a data set like this, right? So you can only look at the chart and you can see the massive amount of big outliers. And what these big outliers do is they can often, skew the data, because remember, you're taking the average of numbers. So if you're looking at something like the lowest number coming in at 8.5 on the VIX and the highest of 89.3, there's a massive divergence between them, a very extreme difference. And the average or the mean for all of those numbers will basically be slightly skewed in terms of what the actual, even though it's mathematically the average, it's not really the number that we are looking for, if that makes sense, because it's skewed in terms of those very extreme levels. But for interesting sake, we can see that for all of the various periods, whether we're looking at 92 to 21, whether we're looking at 2003 to 21 or 2008 to 21, the overall or average of these three number of the averages comes back to about 20. So when we talk about the average VIX stretching throughout all of these periods, we get to a number of about 20. So that's the average. So now we can look at the next one, which is called the median. Now the median number is your middle number, so to speak. So if we arrange the whole data set from the smallest number to the largest number, so that'll mean arranging it from starting at the lowest number, 8.56, arranging it all the way up to 89.53. If we did that and we picked the exact middle number, that'll give us the median. Now for our data, we can see that once again, the median for all three of these time periods came in very close to about 17. And remember that's the middle number for that massive set. Then the final one we can look at is the mode. And the mode is simply the value that occurs the most often in your data set. Now to get this was a little bit tricky because I had to take the data. I had like hundreds and hundreds and hundreds of different numbers. So to make a little bit more sense of an average number, I basically rounded up from the actual number. So instead of taking 18.95 as the VIX, I took 19, etc. So I rounded up for all of these numbers. And then after rounding up, I basically split the data once again into the three different sections. And then I grouped each of these sections from the lowest whole VIX number to the only to about 50. And the reason for 50 is because that's a very outlying number. It's you can see from the chart that it really drops down as we head deeper into those numbers. Let me just quickly open up. There's a combined one that I want to show you. Let's get that on the screen. There we go. Now, looking at this chart, we can obviously see that there's there's a difference in the amount of occurrences on the left-hand side, a vast difference between the three data sets. But you shouldn't really mind that because remember, each of these periods are different in length, right? So we're measuring 92 to 2001, 2003 to 2001, 2008. So the period gets shorter. So obviously there's going to be less occurrences. So the amount of occurrences isn't really the difference, at least between the three periods, isn't important. What is important here is seeing that there's a very similar pattern developing throughout all three of these periods. And that is that the mode of the VIX, remember the number that is most common, is very close to between 12 and 14. Let's just call it 13, right? So we can see by looking at the actual data as well, doing the mode calculation, we can see all three of them coming in very close to 13. So that's the mode. So which one should we use then? Should we use the 20 average? Should we use the 17 median? Or should we use the 13 mode? Well, it's not really that simple because the data of all three is really valuable to understand. But since the mean is more skewed out of all three, the average, since that is a little bit more skewed, what we could do is use a number between the median and a number between the mode, which would roughly give us a number of about 15, give or take. And, if you listen to any type of, a financial news outlet or read articles, you'll normally see 15 quoted as your average, so to speak. I don't want to use that word because it's not accurate, but your average or your normal number of VIX. 15. So if you ask me a historical normal level, which accounts for the slightly higher volatility that we experienced in the markets between 2008 and 2001, I'd say that 15 is a good number to start from as a normal VIX, if you want to call it that. However, there is something very important to keep in mind about this, and that is that a high and low VIX is always going to be relative based on where you were before you got to where you are now, right? So you don't measure so let's go to the chart quickly. So you don't measure today's VIX that's trading at right now 23. You don't measure today's VIX at 23 by comparing it to 15, right? We don't compare today's one to what we are seeing on the charts right now. You don't measure today's VIX where we are trading at, compared to the normal number of 15. It's relative to where it's coming from over the past day, over the past week, over the past month, over the past year, etc. So, for example, a VIX of 60, right? So let's go to a higher time frame here. Now that we know what let's call it normal VIX is of about, let's call it 15, right? If you look at a VIX of 60, that is like an extremely high number historically, right? It's an extremely high VIX. But if you are coming from almost 90, right, then 60 a month or two later, a couple of weeks later, really, is actually a good number, but it's a bad number historically speaking. And vice versa, if you have been meandering around 20 for a very long time, as we have recently, and you suddenly have a spike to up about 35 or 36, relatively speaking, that's going to be a very big jump. It's going to be a very high number. So in that sense, it's nice to have that 15 number in mind, as a possible mean reversion target, because volatility does mean revert, but it's a lot more valuable to expect mean reversion to back to where you are, back to that relative value from where you were trading, let's say a day, a week, a month or so ago. So if we've been meandering around that 21 level or 22 level or 23 level for so long, having spikes below or above that will be high. But obviously we don't measure where we are right now in terms of 15. We measure where we are right now in terms of where we are coming from over the last couple of sessions. So it's very, very important to make that difference. So in that sense, like we said, it's nice to have that 15. But it's always important to gauge current volatility based on where your immediate realized volatility has come from. If we take a look at the VIX after COVID, we have not been able to break and stay below that area of between 20 and 21 since the pandemic began. And if we can finally break into the teens after staying above this level for so long, we've mentioned before that we think that can be a massive tailwind for equities, because remember that lots of fund allocations or portfolio constructions are built using volatility metrics, and volatility is really a key input for them for deciding which assets they can allocate to and how much of their capital they can allocate to it. So if volatility can break lower into a lower regime, as they call it, for volatility, breaking back into the teens, I think that opens up a lot of allocation opportunities for funds to rotate back into equities based on these better volatility numbers. And especially, now that we know that the median starts at about 17, if we can get closer to 17, it shows that we are back to, or very close to, normal, so to speak, right? So there are some participants actually out there who say that the sheer level of option activities that we have right now in the market post-pandemic means that the volatility, the VIX, might never be able to reach lower levels again. That we were used to. The new normal might not be 15. The new normal might be, something closer to 20. And of course, based on the size of your look back period, that certainly might be. If we do the same type of calculations like we did over here, but for a shorter period of time, obviously those calculations will look different. But I'm not too convinced by that level of thoughts right now. I still think that volatility can break lower from where we are right now, but obviously that's purely speculative on my part as well as their part. So just some food for thought on that matter. So Marlo, I hope that has helped with your question on what is a normal level of the VIX, and obviously if there's any other questions, please don't hesitate to let us know.